thank everybody for joining as I continue to do these spaces daily. This will be available as podcasts on all your favorite platforms on the Lead Lag Live banner. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Richard Moglen, who's built quite a following over the last several years, has a great YouTube channel, and does a lot for the trading community. Richard, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? And what are you doing with Trader Lion?
Yeah, first of all, thanks so much for having me. It's great to be on here. Yeah, so I'm relatively new to this. I started trading in 2018, and my background is in mechanical engineering, not even finance or anything like that. I was going and getting my degree at the University of Maryland, which is where I'm from. And I then worked at the Naval Research Lab. But during my junior year at Maryland, I took a class called Introduction to the Stock Market and Technical Analysis, taught by part-time trader for 50 plus years, Dr. Eric Wish. He's on Twitter at Wishing Wealth, and he trades using the Can Slim, William O'Neill style growth trading. And that class just kind of opened my eyes to what's possible. And I really loved, the analysis of it, the process, all of that. It really appealed to kind of how I view things. And I became super passionate about it. I ended up being a teaching assistant for him basically throughout the rest of my college career. And after that, I started a YouTube channel to kind of share what I had learned, because I realized that not everybody gets a chance to take a class like that. It's pretty unique. And I wanted to basically create a resource for people that was free to access on YouTube and also on Twitter, where they can find kind of quality information about, how to trade, how to manage risk, especially what to look for in terms of fundamental analysis, technical analysis, and how to put that all together into a system. So I'll keep it brief and kind of leave it there. Happy to answer any kind of more specific questions, but I think that's a good start.
Do you find that the background in mechanical engineering helps you or hurts you when it comes to looking at markets? And I ask that because I always make this point that trading, investing, this domain that we are all in, like everything, there's a degree of skill, luck, cause, and effect. But the luck side can be larger than other professions, other fields of study. And the cause and effect is sometimes not as linear or clear.
Yeah, that's a really good question. I think overall, my background has helped me immensely. And that's because, engineers, we focus on the system. We focus on building a process that is robust, that is sustainable, that's huge. And often that involves building in a lot of failure. We've got a term with our designs called safety factor, which basically we determine at what level, let's say, a bridge will fail at 10,000 pounds. Well, we need a safety factor of 1.4. So even on the max possible forces that a bridge might experience, it will never exceed that key level. So we build in failure a lot in terms of engineering. And like I said, just focusing on designing a whole system and thinking analytically and thinking logically and kind of assessing things as they are. A lot of those are kind of key principles when it comes to engineering. So I definitely think my background's helped me a lot, and probably helped me more than if I had just done finance or something similar, because it makes you think a little bit differently about the markets.
Yeah, and logic's an interesting term, right? Because the logical thing to do is to make money off of other people's illogical trades or illogical ways of thinking about investing. How do you apply logic in markets from the standpoint that, listen, there have been a lot of things that arguably this year have made sense. A lot of things that also didn't make sense has been quite challenging for asset allocators, for those that are limited in the opportunity set. Talk about how you think about trading logically in an environment that seems to be illogical.
Yeah, well, I focus on my very specific domain and kind of what I'm good at. So in terms of how I view the markets, I view a lot of the macro events, all of that eventually gets distilled and shows up in the price action itself, in the indexes, in the leading stocks, in the mega caps as well. So I view everything kind of through that lens, through technical analysis, pairing that with fundamental analysis, looking for earnings growth, sales growth, all of that. But in terms of coming back to the logic standpoint, I'm just looking at how I view things. I'm kind of filtering everything else out. There's a lot of noise everywhere where it doesn't apply to my process, to my system. So I try to ignore all of that and just focus on a very specific subset of stocks that have the characteristics that I'm looking for, and then looking for specific entries, analyzing trends. Are they in an uptrend, downtrend? If a lot of these stocks, these type of stocks, these leaders, as we call them, are breaking moving averages and starting longer term downtrend on a weekly time frame, on a monthly time frame, that tells me something about the environment. And logically, I should be taking a step back. I shouldn't be looking to be really aggressive, especially to the long side. But on the flip side, once these leaders start to really perform well and test trades that I put on are working, I'm at a profit immediately, breakouts are following through, trends are starting to the upside, that's when logically I should increase my exposure and look to be more aggressive. So that's kind of how I view things. I'm very focused on my style of trading. I try to filter out everything else that's not applicable. Maybe it works for somebody else, but it's not how I view things. And yeah, I try to keep things very simple and really focused. And I think that's a good way to do things in the markets. You want to be very specialized and excel at one thing and really master that, or work towards mastery. Of course, we never actually master anything, but work towards that mastery. And then finally, you can add, a tool here and there if that helps your process. You can test things out, iterate. That's another thing that I think engineering has helped me a lot with is, you try things. If it doesn't work, you go back to square one. But if it works, you try to improve it a little bit. But testing things out and experimenting is a great way to find a new edge, a new system, add to your process. So yeah, just try to be logical and, try to bend with the market and listen to it for feedback.
All right. So you mentioned a small subset of stocks. What stocks are in your opportunity set? Why purposely do you keep it limited? Talk through that a bit, because I think this point about opportunity set is really critical when it comes to systems development.
Yeah. So my first exposure to the markets was through that class, as I said, at the University of Maryland. And in that class, we're basically looking for stocks that match the CAN-SLIM mold, which are basically, CAN-SLIM is an acronym, stands for current earnings, annual earnings, all that, new and improved products, leader versus laggard, and market trends. So what we're looking for there are stocks that match the mold that William O'Neill found in his analysis of the greatest performing stocks of all time. I would highly recommend everybody, if they've never heard about William O'Neill, to check out the book How to Make Money in Stocks. It's fantastic. I think it's like $20. It'd probably be the best investment you'll ever make, best ROE. Definitely check that out, How to Make Money in Stocks. But yeah, basically he analyzed the greatest performing stocks of all time and distilled the characteristics that they all shared. And that's with, incredible earnings growth, both on a quarterly basis, an annual basis. He's looking for a new and innovative product that's disruptive, a huge total addressable market. And he's also pairing that fundamental analysis with a strong price trend. That's really key for me. I'll trade a stock that doesn't have the best fundamentals if it has a great chart and is showing a lot of strength, a lot of momentum. If I can find a logical spot where I can get in on that trend and manage my risk really tightly. But on the flip side, even if a stock has amazing fundamentals, the story is fantastic, what have you, if the chart is in a longer term downtrend, the market is telling you something and it's not telling you that you should be accumulating that stock. So I'm always trying to align both the fundamentals with the technicals. And that's the best ideal combination where, a stock has amazing earnings growth, sales growth, ROE, institutional sponsorship is increasing, and that's paired with a chart that's in a longer term uptrend. We're gapping up on huge volume out of an early stage base, and we're just starting to begin a trend. When all of those things are kind of in sync, that's where the best opportunities come from. But if, as I said, if the story is great, even if the earnings and sales are great, if the chart doesn't show that the stock is under accumulation and maybe is even under distribution, I'm not going to argue with what the market's saying. That's an easy way to, be chopped up into little pieces if you're using stop losses, or just lose a lot of money if you're looking for a longer term investment. I always want to be aligning everything, both the fundamentals and the technicals. And I'm sorry, I completely forgot the original question, but hopefully I answered it at least at some point.
Yeah, no, that's good. It's sort of the point about opportunity set. So I always go back to this idea that fundamentally every single strategy when it comes to trading is a function of three things, right? One is your signal. Two is your look back period on the signal. So moving average is a signal, 50-day move as the look back period. And then the third thing is the opportunity set, right? Sort of what do you execute across? Now, obviously, if you have certain filters that get you to a tighter opportunity set to play around with. But I often find that a lot of the trading community is maybe focused on just some of the very mega cap type of momentum names because that's what's worked, up until really this year. They tend to not really expand out the opportunity set to new things or consider, to your point, sort of iterating on new filters. Is there anything in the CanSlim methodology that, just from your own experience, you somewhat disagree with, that you find maybe is not as important as is emphasized with the CanSlim method?
Yeah, I mean, markets change. I would say at its core, it still works. It still will help you find the best leaders. If you just look back in 2020, Tesla was a textbook CanSlim stock. I think there's more of an emphasis now on sales growth versus earnings growth now. And also that new factor, that N factor in CanSlim matters almost more than that. What is the story? What is the theme that's driving the stock higher? And also in terms of the actual entry points, classic CanSlim is looking to buy breakouts from a base or a consolidation period. I kind of like to look for early entries up the right-hand side of a base, where O'Neill, who is a fantastic trader, obviously a stellar trader, like to buy the pure breakout. I like to look for alternate entry points up the right-hand side where there's kind of mini breakouts from tighter consolidations, tighter areas, as a stock is proving itself up the right-hand side after there's been some type of character change within that base. So I'm looking to get in a little bit earlier because often you can manage your risk a little bit tighter, maybe 3, 4, 5% versus on the full breakout. It might be the stock might be a little bit short-term extended as it's approaching that breakout, and you might have to widen your stop a little bit. I like to keep things a little bit tighter. So yeah, those few things where more emphasis on sales growth and alternate entries. I think those are things that I've kind of changed. I won't say, I've definitely based the core of my methodology still on that CanSlim system, but I've altered it a little bit to match how I like to view things, as well as, changing markets.
That's good for a question.
Yeah, that's a good question. I would say, publishing here on Twitter and sharing your ideas and sharing your process, I think that definitely helps get exposure. I've never worked for a hedge fund. My partner Ross, he's done the money management both under O'Neill as well as at his own hedge fund. So he'd probably be the better person to ask. But yeah, I would say share your ideas on Twitter and interact with other people who are in the business, and that's a good way to make connections.
On Traderline, talk through what it is that you're trying to do with Traderline. So I've had Ross Haber on before one of these spaces, and I'm a fan of Stan Weinstein's. Just talk through what's the objective. Why did you start it? As I understand it, you did start it. Just give us some context around that.
Yeah, our number one goal, and I see some Traderline members in the audience. Joseph, good to see you. But yeah, our number one goal is to build traders. So we're trying to help people establish a process, because often when people are starting out, their actions are very random. They don't have a defined system that they're following, and that doesn't allow you to iterate. If you don't have a base system to start with, you can't really work and look for improvements. So at Traderline, what we look to do is build up people's systems and allow them to basically trade independently. And we equip them with watch lists. We have a ton of proprietary webinars, courses, mini courses. We just started a theme of the month presentation where I write an article, and Ross or Ray does a full presentation explaining an evergreen concept like trading a market cycle or finding the leaders that I talked about previously. So it's a mentorship company. And we also have worked with many fantastic traders like Stan Weinstein, as you mentioned, the author of Secrets for Profiting in Bull and Bear Markets, to create these master classes where we teach their full system. So we just did one with Stan Weinstein earlier this year. Back in late 2021, we did one with Oliver Kell, who is the U.S. investing champion of 2020, which is a real money contest. He returned 941%. So he's a stellar trader. He runs his own fund now. So we kind of have two sides of things. We have the more direct mentorship. If you're looking for a community, you can take a look at Traderline Private Access. And I think you've got a pinned tweet here that has the link to our Black Friday sale. So if you want more information, go ahead and click that. We've got the mentorship side of things, and then we've also got the masterclasses with top traders, as well as Jared Tendler, who, if you haven't had on, I would highly recommend it. He's a great guy, and he focuses more on the trading psychology aspect of things.
I want to go back to what you referenced a little bit earlier, that you need to have some kind of base system. A lot of traders enter the field and they're kind of random in their approach and their thinking. Sometimes they get lucky, sometimes not. And then you iterate around the base system. What makes for a base system? Is it simply having a set of rules, a set of filters? And how do you even judge if, a base system would work longer term if you happen to start that base system in a cycle that doesn't favor it?
Yeah, that's a really good question. So this was actually one of the things that I'm so thankful for, having taken the class at the University of Maryland, because one of the major projects in that class was to write a full trading rule set defining kind of every aspect of what a trading system should have. So that means analyzing market conditions and how are you going to trade in those different market conditions? How are you going to select stocks? How are you going to build that universe? What are your entry tactics? What are your exit tactics? What is your position sizing? How are you going to manage risk, which is the most important thing? So to start with, I would say read How to Make Money in Stocks or Stan Weinstein's book. And those present two very strong trading systems that have a ton of overlap, but have stood the test of time for 50 plus years. A lot of the US investing champions in the past few years, started with a similar system to that. They've iterated, add their own edges, added their own adaptations, but a lot of the core system remains the same. So I would say read those books and then write down a rule set that, as I mentioned, describes how you're going to determine market conditions, stocks to trade, all of that, and write it in a way that somebody with a similar amount of knowledge to you could follow it to a T. You've explained it well enough that they could follow it step by step and come up with the same universe of stocks, same pretty much entry tactics, all of that. And I think just thinking through that whole process saves you a lot of grief later on, because as you mentioned, and as I said as well, when people first start out, there's so much information out there. There's so many indicators to learn, about that it's overwhelming, and people start using the MACD, then they use the RSI, then they're trading Forex, then they're trading crypto, then they're trading stocks, then they're doing options, and they're trying this position size, they're putting on this position size because somebody tweeted this. Everything's very random and I'm looking for the word, very dependent on what other people are saying and what other people are doing. Your goal should be that you should be able to lock yourself in a room with an internet connection, whatever you need for fundamental analysis, technical analysis, and be able to trade independently. That should be your goal. And you should have your own system that obviously is going to change over time because everything improves. The market's going to change itself slightly. So that should be your goal, to come up with a full system that you can act independently of any other person and their opinion. And that way you're responsible for your own successes, your own failures, and you can work to improve over time and just get slightly better with every mistake that you make, because you're definitely going to make mistakes. You're going to learn lessons from that. And yeah, that's pretty much what I would say. Yeah, really good question. So back testing is very difficult to do and is tough to do accurately. And what I mean by that is a lot of CanSlim's effectiveness comes from selecting the right group of stocks, the industry groups that are strong at the time, and going back in history and studying that. It's hard to find that data about this group was leading here. I personally haven't backtested the CanSlim. The AAII group did and found it was the most effective system going back 20 years. I'd have to find that stat. I'll tweet it out later. But what I've done is I've backtested different trend following systems that are similar to mine using moving averages like the 21 EMA. I've got some of those videos posted on my channel. So it's tough to fully backtest a system because there's so many different variables. What is your position size going to be? It's almost impossible to completely encompass what you're going to do. So I think people worry a lot about, is this the best ever system? Does it work perfectly in backtest? Because every market is a little bit different. So what you want is a system that can adapt to that. And CanSlim does that because it's looking for that new leadership. Those new groups are going to outperform, and then using that same kind of technical analysis framework to find great entries that give you good risk reward where you're managing risk tightly. So yeah, that's kind of what I would say. It's really hard to backtest. I think TrendSpider has a pretty cool tool. I've just kind of written things in Python myself, and that's been sufficient. But it's tough to fully backtest a system because of just all the different variables involved. I think AI's study encompassed that system. And Ross, who Michael mentioned earlier, who was a PM for O'Neill at that time, they were in cash after that break very early on. Because what you see with the CanSlim system is the leaders that you're following, as soon as they fail late stage bases and start to break down below their longer term moving averages, you're pushed to cash naturally. Your stops are hit, and that protects you during the longer term declines, and it protected them during that bear market. Now that doesn't mean you're not sucked back in during rallies, and maybe you make some money, maybe you lose some money, but over the long run, you're protected during that longer term downtrend.
By the way, I will say I always make this point that everything in markets is a back test, including buy and hold. Right? I mean, it's a back test with one trade. Nobody ever thinks of it that way, but that's factually true. And there's the old expression: "I never met a back test I didn't like," because obviously you see the back tests that are working. But buy and hold as the back test sometimes also doesn't work. I always reference the example of the back test of buy and hold for Japan failed 30 some odd years ago. So the point is you've got to be able to back test just to have something to hang your head on, to have some confidence that there's some sort of repeatable cause and effect, but it's obviously by no means guaranteed.
100%. And if you can't beat buy and hold, you should probably just do buy and hold, right?
Yeah, no, exactly right. Right. Well, and actually, that's another interesting thing, Richard. So, which I'm always amazed by. If you're in the industry long enough, this is one of those wildly frustrating aspects of investing, which is that everybody seems to want to quote unquote beat the market, and everyone's definition of the market is really just the S&P 500. Even though in reality, that's not the right benchmark for most people. It ends up, I think, causing a false sense of comparative analysis on their backtest versus, a do nothing type of index. How do you get people away from this desire to do better than the S&P? Because if you want to do better than the S&P, sometimes the only way to do that is with leverage, if it's the only game in town. And that has its own problems longer term.
Yeah, that's a good question. I would say the goal for every system should be to make money overall. Like assessing versus a benchmark doesn't make so much sense if you're not being judged by that, if you're not managing money for a firm or whatever. But what you want to think about is that the market every single day has so many different opportunities that you can take advantage of, and too many that you can't take advantage of all of them. So, for the Cancelim system, there's times where the market will rally 3% and you're in cash because there's no setups, and everything that's causing the market to rally is just oversold stuff bouncing within downtrends. That's happened many times this year. So you're not involved on that day, but you've been protecting yourself during the longer term downtrend. So over the longer term, you're following that trend, but on that single day, you're not benefiting from that one single day. And I think people have this sense that you to be a successful trader, you have to be involved all the time, and you have to be making money every day. And that's there's nothing further from the truth. You make money when your strategy is performing really well. And there's specific times during the year when that happens. And that doesn't always correlate with how the indexes are doing. Obviously, the indexes being in an uptrend is going to boost everything because you're riding that tailwind as well. But things really line up at specific times of the year. And this year, we've had a few kind of bear market rallies where there's been opportunities, obviously not much this year. But, your performance is not always tied completely to the indexes. And you want to recognize the fact that you can perform well when the indexes aren't. And likewise, when the indexes are doing well, that doesn't necessarily mean your strategy that you're following is going to excel. So yeah, you don't want to tie yourself too much to a benchmark and just kind of focus on your process, your system, and do pretty well. Because, comparing yourself to an index or just comparing yourself to another trader, it doesn't really help you perform. You really want to stay focused on what you're doing and just try and improve that as much as you can.
Yeah, and let me expand on that because I think it's an interesting question. I think it's probably more problematic in the crypto space or kind of less regulated areas. But backtesting is a function of assumes that it's not a scam, obviously, right? That something that's going up is not going to is a legitimate thing that suddenly doesn't no longer exist because of it getting caught, right? I do think it's interesting. Again, going back to backtesting. So I go back to you need to have enough data points. You need to also have confidence that the thing is not fundamentally broken. So when you do the Cancelim method, presumably there are, part of that filtering is to make sure that a company is legitimate, right? Because it's got growth and all that. Is there anything has there ever been a stock in the Cancelim method or in the filter that you go through that made you sort of wonder if that should even be sort of the conclusion of the analysis? In other words, maybe it is something that's like an Enron that isn't legitimate, but would have passed the Cancelim filters, but there's fraud there.
Yeah, that's a really good question. A big filter for Cancelim is you want to be trading liquid stocks. So for me, I kind of look at it from a dollar volume point of view, and dollar volume is just pretty much, the closing price multiplied by the 50-day average volume. So that gives you a sense of how much money is being traded in that stock every single day. And I look for pretty much above $20 million volume at the very low end. And I much prefer much more liquid stocks like 50 million, 100 million, because what we're looking for with the CAN-SLIM system is stocks that are being accumulated by the largest growth funds and institutions. And they're not able to trade, they're not able to invest, build positions in stocks that aren't liquid. And as a kind of rule, I like to trade stocks that have a bigger capitalization than 1 billion. That just kind of seems to work pretty well. And kind of that sweet spot is between 5 billion and 25 billion, 30 billion, where the company is established. It's got significant earnings. They're not just 300% growth on $1 million in revenue. It's significant revenue, it's significant earnings. And it's established. It's already a pretty big size, but it's got a lot of potential, a lot of runway still to go. Earnings growth is strong. They're coming up with new and innovative products that, have we always say this, have the potential to change how we work, live, and play. That, if you think about Zoom, if you think about Tesla, those fit that mold perfectly. And yeah, so we're looking for young companies that are a decent size already, but have a lot of room to grow and could become a much bigger company in the future, 5 years down the line, 10 years down the line. So we're not trading speculative names that are trading at $1. We're usually trading above $15. The higher, the better. And we're making sure that stuff is liquid and, isn't just moving based on pump and dump news and all of that. So yeah, there's definitely a quality filter that we apply over the CAN-SLIM criteria that makes sure that we're filtering out those stocks that don't match it.
So the remaining minutes here, so everyone please make sure you follow Richard on Twitter if you're curious about the various courses that TraderLine puts out. You can see it in the pinned tweet. Again, this will be a podcast on all of your favorite platforms.
Yeah, so it sounds like you're trying to find your process for trading. Is that kind of right? Yeah, that's not really how I trade. How I trade it is I'm kind of looking for growth companies that, as I mentioned, like the fundamental analysis is aligning with the technicals. If you're looking for a more defined system or just to learn technical analysis a little bit better, which, whatever method you're using to find opportunities is going to help you, I'd really recommend reading How to Make Money in Stocks by O'Neill and also Secrets for Profiting in Bull Bear Markets by Stan Weinstein. Both of those will align really nicely with your kind of investing framework, since you said you're more of a long-term investor, and they'll provide you that structure for pairing the technical analysis with the fundamental analysis that I think should come up and perform really well. So that would kind of be my recommendation.
But I think this is kind of a good transition to a bigger question. So I always make this point also, Richard, that at the end of the day, it's actually very simple investing and trading. It all ultimately goes down to just one question, right? Which is that has the current price overreacted or underreacted to all available information, right? Because that's all that we're trying to play off. So if you're trying to your point, if you have a big spike up, maybe that's an overreaction in your analysis, so you sell that, right? If something goes down heavy, that's an overreaction too. If something's going up slowly, maybe that's an underreaction to how the true value of the company should play out. So, Richard, let's go with that as sort of a thought process, because I do think part of trading and systems development is not just a function of rules, but also a function of behavior and how that filters into the persistence of a trend.
Yeah, because charts at the end of the day are a reflection of human behavior and what all the different participants in the stock think of, the prospects. So how I kind of view things is when I'm looking at a stock chart, say you give me, ticker XYZ, the first thing I'm going to do is going to put it up, look at it a weekly chart, on a daily chart as well, and look for clues of whether it's under accumulation or distribution by the largest funds who do most of the trading and control really the direction that the companies are going to go on. And what are the clues that I'm looking for? I'm looking for, one, is it in a longer term uptrend above a rising 200-day moving average or 50-day moving average? If it is, it's likely under some sort of accumulation. It's in some sort of uptrend. And then I'm looking for large volume moves to the upside that really suggest that there's a lot of conviction and basically that the institutions really want that stock at that moment. And these moves on large volume are often just the start of a longer term trend. So if you are able to look for those early and analyze those signs, then you're able to look for, after that occurs, low risk entry spots after the stock kind of calms down a bit, consolidates, pulls back into a moving average, something like that. And then you're able to, enter at a low risk, potential high reward spot in a stock that's in a longer term uptrend, that's already moving in the direction you want, as just kind of bouncing off support or resuming that uptrend, that longer term uptrend after pulling back and consolidating. So that's kind of what I look for in terms of analyzing human behavior. I'm looking for basically evidence in the stock chart that there are some big players that really want to accumulate that stock. They see something in the stock's future. Maybe they're doing fundamental analysis, maybe they're doing technical, whatever their reasons for doing and accumulating that stock, because they're such a large force in the market. I'm looking for evidence that they're there and they're accumulating. And the greatest example of this is a huge gap up on earnings where there's a catalyst. Because what a gap up on earnings is basically an indication that the street was completely caught off guard and the company completely surprised them, and they have to immediately start building positions and change their allocation in that particular stock. And if you look back at Tesla in 2019, this stock was doing pretty much nothing for years since it had that really nice IPO run. So it had the IPO run in 2013, and then pretty much it went sideways from 2014 all the way until fall of 2019. But on, looks like late October 23rd in 2019, we had a huge gap up on earnings on the highest volume in quite a while. And that trend basically started from that day, because what happens when the street is caught off guard is that the largest funds and institutions, the growth funds, need to start building up positions. But because their positions that they want are, millions of shares, they're not able to go out and buy that on one single day. So that trend is likely to continue as they continue to accumulate. As the stock pulls back to the moving averages, they accumulate a little bit more, and they're fighting other funds who are trying to do the same thing. And then we, as kind of retail traders or investors, whatever you want to call ourselves, it's just labels at this point, we're able to, ride that trend that this accumulation creates and ride that human behavior and basically profit off that trend after we notice that character change in the stock. So a lot of what I do and how I look at the markets is I'm looking for specific price patterns or price movements that indicates that there's a character change in the stock. This could be a positive one, like this earnings, gap up that I just mentioned, or it could be a negative one where we've got a gap down on huge volume, like we saw in Fastly in late 2020. And that says something again about what institutions are thinking about that stock. They're trying to get out of it, and they don't care what price they're trying to get out of it. And that stock is down, I think 90+% from that gap down at this point. So if you're able to look for these character change points, and breaks and moving averages is another example to the upside or the downside. If you're able to analyze and identify these points, that can tell you a lot about what's going on behind the scenes, what people are thinking about the prospects of a company, and then you can take advantage of it once you find an entry tactic after that significant event.
By the way, I'm glad you mentioned that as an example, because that's a concept that's an anomaly that's been outlined in various academic papers. It's called post-earnings announcement drift, right? PEAD, right? So it's exactly, which goes back to the underreaction point. So if you have a gap up on earnings that are surprising, the history would suggest that historically there's drift, that it continues in that direction for a few weeks. And that's an anomaly in the context of what are supposed to be efficient markets, because you'd assume once the data is out there, once the earnings are released, the price would immediately reflect it. But it's actually quite the opposite. There ends up being this kind of persistence and momentum afterwards.
Yeah, it's because of that size problem. The institutions that have to adapt their allocations based on what their models say or what a stock should be worth now based on that huge earnings beat, they're not able to, change their position sizing on a dime. If you're moving around, millions and millions of shares, you have to do that over time, over weeks and months. And that creates an opportunity, that creates that trend that we can take advantage of.
I want to hear your thoughts on the current short and intermediate term market setup. I saw your YouTube video. Sounds to me like you believe that we're probably going to push higher, but talk about how you're assessing the end of the year and maybe how we enter next year.
Yeah, at this moment, so just taking a step back, how I look at what the market conditions are is I always take a look at kind of the major indexes, the NASDAQ, the S&P 500, the Russell 2000, try to get a broad sense of what, the indexes are showing. And what I look at very simply is, are they above a rising or declining 21-day exponential moving average, a rising or declining 50-day moving average, and then a rising or declining 200-day moving average? So those kind of three different time frames where 21 EMA is kind of very short term or intermediate term, depending on your style. 50 days a little bit more intermediate term, and 200-day is kind of that longer term. If you look back in history and just look at key turning points, those moving averages and where we are with respect to them gave you fair warning. So on the very short term, right now we're above a rising 21 EMA on, I'm looking at the QQQ, the NASDAQ 100 ETF right now. We're back above the 50 SMA, but that's declining as of this moment. And we remain below a declining 200-day moving average. So what that tells me, those three things, is in the short term, we're in an intermediate term rally or short-term rally. The intermediate term is just kind of maybe improving here and shaping up. And we remain in a longer term bear market as of this moment. Now, the NASDAQ is kind of the lagging index as of this moment. The S&P 500 looks better. The Dow, although I don't really pay attention to that, is above its 200-day moving average already. The Russell is shaping up. So looking at all those things together, and just also the individual stocks themselves, the leaders, things are improving here. We've got more setups to look at. My watch list is bigger than it's been in quite a while. So those two things, we're back above the 21 EMA, we're back above the 50 SMA, and my watch list is improving. Setups are kind of following through. We've seen some breakouts work. That tells me that things are shaping up a little bit. Now, that could change next week. We could completely undercut those moving averages. Setups could fail, breakouts could fail, and that would change what I think about the trend of the market, and I adapt my position sizing, my exposure to match that. But I think the key thing is we're still not out of the woods yet. We're in a longer term bear market because that 200-day moving average is still above the NASDAQ. We're declining still here. So as of this moment, there's no reason to call this, a new bull market. It's just a rally at this point. And I think a lot of people kind of get wrapped up in all these terms and bull market, bear market. The key thing is, are you able to make money or are you not? And for a trader, that comes from, how have your recent setups been doing? Are they working? Are they following through? Or are breakouts failing and they're just not working? And there's a phrase coined by Mark Minervini where there's an easy dollar environment and then there's a hard penny market. So hard penny markets means, you can do a lot of action, a lot of trading and not really get anything out of it or even lose money, while there's an easy dollar environment, which is when setups are really working, breakouts are falling through dramatically on huge volume, you're at a profit immediately. And we're not quite in that easy dollar environment just yet. But things, in terms of how I view things, are improving under the hood. Maybe we need a little bit more of a consolidation, a lot of choppiness. If you go back and study bear markets in history, even after the market has bottomed, we often go sideways, whipsaw up and down for a while before we get a nice sustained trend again. So yeah, that's kind of how I view things right now. And yeah, anything specific you wanted to talk about with regards to that?
Maybe just kind of go with that as an idea, sort of structuring risk around moving averages when you're touching it, right? Because that's always sort of the critical question, right? Are you gonna break through it on the upside or on the downside? And either way, it's probably going to be, at least potentially a big move.
Yeah, so I don't just buy just because we regain a moving average. What I'm looking for is really kind of a tight area right near those moving averages, where if we pop above that tight area, then I can set my stop loss at basically the low of that range of that tight area, or just below that moving average. So that's kind of how I do things. Very simply, set my stop loss below a higher low. That's something that I really like to do. And then if it works, that's great. But if it doesn't and it undercuts my stop loss, no harm done. I've taken a small loss, and we'll get them next time on the next setup. So that's kind of how I do things. Keep it really simple.
What I was going to ask is, Richard, when you do the CanSlim filtering, is there anything that the number of stocks that are now appearing or maybe disappearing, does that tell you anything about the likelihood of a broader macro move? In other words, is there anything that you've seen that would suggest that CanSlim, the number of stocks, the breadth, so to speak, of CanSlim names is a tell?
Yeah, absolutely. So this is something that Ross, who I know you had on before, is big on. You need to have, 3 to 4 what we call leadership groups that you can have kind of rotation between to lead us into a new bull market. So what we're looking for, is broad leadership. There's a lot of stocks working, a lot of setups breaking out. And also there's something on MarketSmith, which is a software that a lot of CanSlim traders use, called the MarketSmith Growth 250, which is basically just a programmatically created watch list that looks for the CanSlim criteria, basically, very simply. And, for a lot of this year, there's been 150 stocks on that. 170 stocks, and it's called the Growth 250 for a reason. It often has around that number, even more than that. And I'm not sure what it has right now, that Growth 250 list, but that list has expanded quite a bit, and I think is much closer to that 250, 300 mark. So a lot of that is just based on, is the stock above the moving averages? Because that's a key component of whether a stock is tradable based on the CAN-SLIM system. If we're not above at least that 200-day moving average, or at the very least the 50-day, it's probably not a good candidate for CAN-SLIM traders. So that's kind of what I would say. But absolutely, breadth is super important, and breadth of leadership, where you can have rotation between groups. Earlier this year, we had some good runs in the solar stocks, but it was really only the solar stocks and energy stocks that were working. And now we have a little bit more. It's still developing. We've got the solar stocks working. Semiconductors have been strong recently. So we've got a little bit more breadth there. And biotech has been strong all year as well. So you want to have, 4 to 5 groups that are acting well, where, if one group is consolidating a certain week, the other groups kind of, take things up and support the market and lead us higher. So absolutely, kind of breadth of leadership is super, super important.
I think here's real quick on that, because it's, in 2020 is when you started seeing really a big explosion on options trading. I think interest in options in general, compared to 2020 when it comes to Trader Lion and sort of the type of CAN-SLIM or structurally sound type of systems that you advocate for. Do you find that there's bigger interest now, maybe as options trading has been too out there? From a subscription perspective, right, you always have to think about competing against other types of content when a particular part of the market is hot. So when options are hot, everybody wants to subscribe to options research services. When options are not so hot and things are more challenging, maybe they want more fundamentally driven. So I'm just curious, kind of your own observation there.
Yeah, I mean, the same is true for kind of the larger, when the market is doing well, everybody wants to trade. When the market's not doing well, nobody wants to trade and be a part of these services. Options specifically, it's kind of more leverage, so it's a little bit riskier. And I think a lot of people love options because, you get 100% gains, 200% gains, and it's kind of that immediate gratification. But you can do incredibly well just trading shares and having concentrated positions and strong stocks and nice uptrends. And the U.S. Investing Championship that I referenced earlier, a lot of those performers only trade stocks, only trade shares, and they're able to put up 200%, 300%, 400% plus in a strong market. So I think options are risky. You definitely have to do your own due diligence. It's something I haven't really investigated myself too much.
Okay, and maybe just for the remaining few minutes here, again, everybody please make sure you follow Richard and check out Trader Lion and the various courses that they've put out if you're interested. I'm going to assume it's a similar dynamic as is the case with most endeavors, which is that people get interested in trading and they either stick to it or don't stick to it based on initial success, right? It's always a function of that. What does it take to be a successful longer-term trader when you happen to start in a period that your trading is not working? Because I think this is really, at the end of the day, what really drives the likelihood of somebody generating real profits, right? It's the ability to stick to it. And if you happen to start at the exact wrong time, at the exact wrong cycle, it's hard to really get somebody to want to keep trying.
Yeah, it's definitely tough. And so another thing, I didn't even mention it, but I've got a YouTube channel and I also do that. Also do this on the Trader Lion side of things, where I basically interview great traders. So I've had Joe on there. I've had Mark Minervini, Stan Weinstein as well. And one thing that I've noticed that all these great traders share where they've had success is they're super passionate and in love with the process of trading. A lot of them did start, shortly before or during bull markets, so it kind of entices them a little bit. And then a lot of them, gave a lot of those initial profits in the resulting kind of bear market after that. But they loved it enough, and they loved the process and everything, building a system enough that they're able to survive, and they were passionate enough to keep going and just try to learn a little bit more, improve their risk management, all of that. So I think love of trading and the process and the grind is definitely important. And then also just finding a system that matches their lifestyle, whether they work full time so they can only really invest and look on weekends, that's fine. You just have to find a system that works for you or matches your personality and how risk averse you are. And if you want to be a maverick and trade large, you got to find a system that works for that and manages risk enough. But yeah, I would say love of trading is the biggest thing. Everybody who's been successful really loves this, is optimistic, really looking forward to the next bull market right now and getting excited when we're going through corrections because they know that coming out of it are going to be tremendous opportunities.
Yeah, and it's hard to teach passion. I think it's sort of the key point, right? It's kind of somewhat embedded in us.
Yeah,
and we
you just kind of
right?
catch the trading bug. Sorry to talk over you.
Yeah, no, exactly right. That's my point. I think passion is what keeps you in the game, right? So, and I think that's where maybe a lot of people underestimate how important the self is when it comes to, again, longer term success and self education. They think that if they just read books, that's enough. It's not. It's got to be. There's always a personality aspect to being successful, and part of that personality aspect is having the grit to keep going when your approach isn't working. But anyway, everybody here, thank you again for joining. Richard, any final thoughts here for the audience or anything else that you want to talk about?
Nothing too much. Just if you're completely new to kind of what I was saying, I'd highly recommend checking out How to Make Money in Stocks by O'Neill. Stan Weinstein's book is fantastic. And also over at Traderline, we're running a Black Friday sale, both on our mentorship program as well as our masterclasses with Stan Weinstein himself, Oliver Kell, Jared Tendler. Whatever you're kind of looking for, you should be able to find a really great educational product. And I've been involved personally with all of those, hosting them, developing all the resources, all the chart books, everything. So I highly recommend those. And I think it's a great way to prepare yourself for the next bull market and really take advantage of finding those leaders. I mean, it's going to happen. What's going to happen? It's tough. We got to get back above the 200-day moving average on the indexes and all those stocks and have that 200-day moving average shape up as well. So it will happen when it will happen is kind of a non-answer, but that's kind of the truth.
I'd add real quick to that, and because I do have to wrap up here, but I think it's important to keep things in real terms, not nominal terms. So even if you made new highs on the Dow, because oftentimes the media will say, oh, we're entering a new bull market because you already went up 20%. It's irrelevant because even if you hit the prior highs, you're still down on a real return basis, right? So you have to always adjust for inflation. More of a side note in terms of how to think about whether the environment is really a bull market or a bear market. But regardless, thank everybody for joining. Thank you, Richard, and everybody enjoy the rest of your day.